In the last 48 hours, something happened in the precious metals market that hasn't occurred since the 2008 financial collapse. And if you don't understand what just shifted, you're about to get caught on the wrong side of the biggest wealth transfer in modern history. Right now, while you're watching this video, there's a war happening. Not the kind you see on the news. This is a war between paper promises and physical reality, between what the market says silver is worth and what it actually costs to hold it in your hand. And that gap, it just became a chasm. See, most people think precious metals move because of tweets or interest rates or some Federal Reserve announcement. They're not entirely wrong, but they're missing the forest for the trees. What's happening right now in silver isn't just about price. It's about something far more fundamental. It's about what happens when the thing people use to measure value loses its ability to measure anything at all. Let me paint you a picture of the last 72 hours. Gold surged over $300 in a single trading session. That's the largest one-day move since Lehman Brothers collapsed. We're talking about a $2 trillion swing in market value. To put that in perspective, that's roughly equivalent to the entire market capitalization of Amazon. Except there's no earnings call, no product launch, no CEO standing on a stage, just the oldest form of money on earth reminding everyone it still exists. But here's where it gets interesting. While gold jumped 6%, silver exploded 14% higher. Copper rallied right alongside them. Now, when you see gold, silver, and copper all moving in the same direction at the same time, that's not speculation. That's not retail traders getting excited about some TikTok video. That's the market repricing what money actually represents. The futures markets went absolutely haywire. Western spot prices hit $85 per ounce. But in Shanghai, $100. That's a $15 premium, 18% higher than what Americans are paying. Think about that for a second. The same metal, the same day, two completely different prices depending on which side of the Pacific Ocean you're standing on. And here's the kicker. You can see the price on your screen, but good luck actually buying the physical metal. Now, this is where the story gets uncomfortable for a lot of people in the financial establishment. Major bullion dealers just put out alerts that physical silver is nearly impossible to source. Mints are closed. Refineries are backlogged for months. Competitors' inventories are completely empty. One of the largest dealers in Asia had to slash their minimum order requirements in half, from 20,000 Singapore dollars down to 10,000 just to keep customers able to transact. Let me be crystal clear about what that means. When dealers lower minimums, they're not doing it to be nice. They're doing it because demand is so ferocious and supply is so constrained that they need to ration access. It's like a grocery store during a hurricane limiting customers to 2 bottles of water each. It's a scarcity signal. But wait, you might be thinking, if silver is at $85 and it's impossible to buy, why isn't the price higher? Excellent question. And this is where we need to talk about the difference between paper silver and physical silver. See, when you look at the price of silver on your phone, you're looking at futures contracts traded on exchanges like the COMEX. These are paper promises, contracts that say someone will deliver silver at some point in the future. The vast majority of these contracts never result in physical delivery. They're just bets on the direction of the price. But physical silver, that's actual metal you can hold. And right now, there's a massive disconnect between what paper contracts say silver is worth and what it costs to actually get your hands on a bar or a coin. This disconnect doesn't last forever. Eventually, one of two things happens. Either the paper price rises to meet physical reality, or physical premiums collapse as supply comes back online. The question is, which one happens first? Here's what almost nobody in the mainstream financial media is connecting right now. While silver prices have been absolutely volatile, swinging from over $100 down to $70 and now bouncing back to $85, something else has been happening quietly in the background. Central banks around the world have been accumulating gold for 33 consecutive months. Not 33 weeks, 33 months, nearly 3 years without a single month of net selling. In the most recent data, central banks purchased 328 tons of gold. Poland alone bought over 100 tons. Kazakhstan added 57. These aren't small players hedging bets. These are sovereign nations making strategic decisions about what they want to hold as reserves instead of dollars or euros. And here's the part that should make you sit up and pay attention. The 12-month moving average of central bank gold purchases is running at 27 tons per month. That's enormous. That's nations looking at the global financial system and deciding they want assets that don't depend on someone else's promise to pay. Now, silver and gold obviously aren't the same thing. Central banks hoard gold, not silver, but they're part of the same monetary ecosystem. When the world's most sophisticated financial actors are loading up on physical precious metals while telling their citizens everything is fine, that's a signal worth paying attention to. But here's the catch, and this is where a lot of people get wrecked. Just because the long-term fundamental case for precious metals is strong doesn't mean the short-term price action is going to be smooth. In fact, it's going to be the opposite. Let me show you why. If we look at the futures market data, something fascinating just happened. The total open interest in COMEX silver contracts just hit the lowest level since May. For gold, the lowest since June. Open interest is basically the total number of active contracts in the market. When it craters like this, it means one thing: forced liquidation. Leveraged traders got margin calls. They couldn't meet them. Their positions got closed out automatically. Weak hands exited the market, sometimes at massive losses. Now, if you think this volatility is unusual, let me give you some historical context that might blow your mind. During Germany's hyperinflation period from 1914 to 1923, the gold price increased 1 billion times. Yes, you heard that correctly. 1 billion. But here's the part they don't tell you in the history books. The monthly volatility during that period ranged from negative 30% to positive 160%. Even if you had perfect foresight, even if you knew gold was going to multiply by 1 billion, you would have experienced gut-wrenching volatility along the way. Months where you were down 30%. Months where you doubled, and you would have had no idea which month was which until it was over. This is normal in precious metals bull markets during currency crises. The volatility isn't a bug. It's a feature. It's part of the process of repricing monetary assets during periods of systemic stress. And make no mistake, we are in a period of systemic stress right now. Bitcoin just dropped below $74,000 for the first time since April. The S&P 500 closed down 0.8%. NASDAQ fell 1.5%. The Wall Street Fear and Greed Index is sitting at 39, which puts us firmly back in fear territory. But here's where it gets really interesting. Global bond yields are spiking. And when I say spiking, I mean genuinely alarming moves. Germany's 30-year bond yield just climbed to the highest level since 2011. The US 10-year Treasury yield is approaching the highest level since last August. Japan's 10-year yield is near the highest since 1999. Let that sink in. Japan's bond yields haven't been this high since the end of the 90s. This is systemic stress. When bond yields spike globally, it means investors are demanding higher returns to compensate for risk. It means the world's safest assets are suddenly looking a lot less safe. And when that happens, everything sells initially. Stocks sell, bonds sell, crypto sells, and yes, even gold and silver sell in the short term as everyone rushes to raise cash and wait for clarity. But here's the pattern that always plays out. After the initial panic subsides, capital flows to actual safe havens. Not perceived safe havens, actual ones. Assets that don't depend on a government's promise or a central bank's printing press, and we might be seeing the early stages of that transition right now. Now, I want to get into some technical analysis for a moment, because this is important for understanding where we might be heading next. There's a specific moving average that professional traders watch closely, the 150 exponential moving average on the hourly chart. I know that sounds complicated, but stick with me because this matters. A few days ago, this moving average was sitting right around $86. The price tested that level and bounced. Then it rallied up into the high 80s, nearly touching $90, but it got rejected. Buyers tried to push through, couldn't hold, and the price came back down. Now that same moving average has shifted up to $96. And here's the critical part. Silver is currently trading at $85, which means we're $11 below that key resistance level. When a support level breaks and turns into resistance, that's what technical analysts call a bearish flip. It means the momentum has shifted. The bulls lost control of that territory and now have to fight to get it back. So the question everyone should be asking is, can silver reclaim $90 and push through 96, or are we going to see another leg down? Let me lay out the bullish argument first, because it's actually pretty compelling. Physical scarcity is real. This isn't some conspiracy theory. Mints are objectively closed. Refineries are objectively backlogged. Major dealers are objectively empty. You can call them yourself and verify this. When physical supply is this tight and the paper price is at $85, the disconnect is extreme. Eventually, that disconnect has to resolve. Either the paper price rises to reflect physical scarcity, or supply increases and physical premiums collapse. But here's the thing, you can't just magic new silver into existence overnight. Mining operations take years to ramp up. Refineries have capacity constraints. Mints have production limits. So even if demand stays flat, it's going to take time for supply to catch up. Meanwhile, central banks keep buying gold. Sovereign nations keep diversifying away from dollar reserves. The Chinese yuan just hit its strongest level against the US dollar since May of 2023. Pricing power is shifting east. And if you look at the data, Chinese and Indian citizens have been accumulating precious metals, regardless of what central banks do. We're talking about 3 billion people with a cultural affinity for gold and silver as savings vehicles. That's not a trade. That's a multi-generational wealth preservation strategy. Additionally, some credible analysts are raising their price targets right now while everyone else is panicking. David Hunter, who has a track record of major macro calls, just raised his gold target from $5,500 to $6,800 and his silver target from $125 to $180. Those aren't small adjustments. Those are massive upward revisions in the middle of a correction. But let's be honest about the bearish case, because ignoring it would be intellectually dishonest. The rejection at $87 to $90 matters. That was a test of resistance, and the bulls failed. Price got pushed back down. That's a warning sign that momentum hasn't fully shifted yet. The 150 exponential moving average at 96 is now overhead resistance. We're $11 below it. If we can't reclaim 90 and hold above 96, the next test could be significantly lower. Some analysts are looking at a potential retest of the $71 low we saw recently. Geopolitical risk is escalating. There are reports of potential military conflict between the US and Iran. Now, you'd think war would be bullish for precious metals, and long-term it usually is, but the initial reaction to geopolitical shocks is often risk-off across the board. Sell everything, raise cash, wait for clarity. Only after the dust settles does the safe haven bid kick in. So if tensions worsen before they improve, we could see more volatility and potentially more downside before any sustained rally begins. And let's talk about leverage for a second, because this is where people get absolutely demolished. The silver market is notorious for extreme volatility. We just saw a move from over $100 down to $70 and back up to $85 in a matter of weeks. That's a 40% crash followed by an 18% bounce. If you're trading with leverage, that kind of volatility doesn't just hurt, it kills. Even if you're directionally correct, the intraday swings can trigger margin calls and force you out of positions before the move you anticipated actually happens. I've seen traders who were absolutely right about the long-term direction get stopped out at the worst possible moment because they were using too much leverage. They watched from the sidelines as the market did exactly what they predicted, but they weren't in the trade anymore because they got shaken out. This is why professional risk managers obsess over position sizing. It's not about being right. It's about being right and still being in the game when it matters. And here's something most people don't understand. Even physical holders aren't immune to volatility risk. Premiums can collapse as fast as they spike. If you bought physical silver at $80 with a 20% premium, you paid $96. If the spot price drops to $70 and premiums compress to 10%, you're holding metal worth $77. You didn't use leverage, you bought physical, but you still took a significant hit. So, where does this leave us? What are the realistic scenarios from here? Scenario 1. Silver reclaims $90, breaks through the 96 resistance, and confirms that the bottom is in. From there, we could see a sustained rally toward the previous highs and potentially beyond. The physical scarcity supports this narrative. Central bank accumulation supports it. The weakening dollar supports it. Scenario 2, silver fails to reclaim 90, loses 80, and retests the 71 low, or potentially goes even lower. This would likely coincide with broader market stress, continued risk-off sentiment, and forced liquidation of remaining leverage positions. The technical picture supports this possibility. The overhead resistance supports it. Geopolitical uncertainty supports it. Scenario 3, and this is the one I think is most likely. We chop around in this range for a while. Test 90, get rejected. Test 80, get support. Rinse and repeat until either the physical shortage becomes so severe that it forces the paper price higher, or supply comes back online and premiums normalize. The truth is, nobody knows which scenario plays out. Anyone who tells you they know with certainty is either lying or delusional. What we can do is look at probabilities, manage risk, and make informed decisions based on our individual circumstances and time horizons. So what should you actually do with this information? First, understand what kind of participant you are. Are you a long-term stacker with a time horizon of years or decades, or are you a trader trying to capitalize on short-term moves? If you're a long-term stacker, this volatility is noise. Daily charts, hourly moving averages, technical resistance levels, none of it matters if your thesis is based on monetary debasement, industrial demand growth, and central bank accumulation over the next 5 to 10 years. For stackers, the only questions that matter are, can you source physical metal, and is the premium reasonable relative to historical norms? If the answer to both is yes, then corrections like this are buying opportunities, not reasons to panic. But if you're trading, if you're using leverage, if you're playing short-term moves, then every level matters. You need to know your entry points, your exit points, your stop losses, and your risk tolerance. You need to understand that this volatility can wipe out accounts before you have time to react. And here's the critical point that nobody wants to hear. You could be absolutely right about the long-term direction and still lose money if your timing or position sizing is wrong. Second, diversification matters. I don't care how bullish you are on silver. Putting your entire net worth into any single asset is gambling, not investing, even physical precious metals. Third, ignore the noise. Turn off the minute-by-minute price alerts. Stop checking your portfolio every hour. Zoom out. Look at the big picture. Ask yourself if the fundamental reasons you got into this position in the first place have changed. Have global debt levels suddenly disappeared? Has currency debasement reversed? Has industrial demand for silver collapsed? Has the green energy transition been canceled? If the answer is no, then short-term volatility is just that, short-term. Look, here's the bottom line. We're living through a period of unprecedented monetary experimentation. Global debt is at levels never seen in human history. Central banks are trapped between inflation and recession. Currencies are being debased in real time, and the system is showing cracks. What happened in the last 72 hours in the precious metals market isn't just about price. It's a symptom of something deeper. It's a signal that the world is starting to question what money actually is and what it should be backed by. Paper promises? Or physical reality? The market is trying to answer that question right now. And the answer is going to have profound implications for your wealth, your purchasing power, and your financial future. Silver might go to $180 like some analysts predict, or it might retest 70. I don't know. You don't know. Nobody knows. But what I do know is this. The fundamentals haven't changed. The scarcity is real, the demand is real, the monetary instability is real. And in a world where you can't trust the value of currency, having a portion of your wealth in assets that don't depend on someone else's promise to pay isn't speculation, it's insurance. So do your own research, understand the risks, know your time horizon, size your positions appropriately, and whatever you do, don't let fear or greed make your decisions for you. Plan with logic, act with discipline, and remember that in markets like these, survival is more important than being a hero. If this breakdown helped you see the silver market more clearly, make sure you subscribe because we're going to keep tracking this story as it unfolds. Drop a comment and let me know. Do you think we've seen the bottom, or is more pain coming? Stay sharp out there.